Test. Hi, welcome. Good evening to all. We still close about 5 minutes before we start the presentation. Just a quick shout out for those who are already in the room. Can you all hear me loud and clear? And do you all see my screen? Yeah. Hi, good evening to all. Let's wait for about another 5 more minutes before we start this quarterly outlook. So I believe that most of you all here are kind of eager where are the markets will be heading next. So I'll be sharing a very interesting technical analysis chart for you all to actually take a look at it later. So let's take a look. Let's wait for about another 5 more minutes. Yeah. Hi, good evening, ladies and gentlemen. So we'll be starting very soon. So I believe that all of you are able to see the screen, as well as hear me kind of loud and clear. So thank you for joining your time this evening with me. So I'm actually Kelvin. So basically, let me share my webcam for you all. Yeah, hi. Yeah, hi. I'm Calvin here. So basically, I believe that some of you all have seen me before. So in fact, previously I've conducted this kind of market outlook seminar for the last 6 to 7 years, not with CMC, with other firms. So I'm now pretty glad that I'm part of CMC family right now. So usually my market outlook seminar and my other market related seminar, we do it in person live, but unfortunately due to the current pandemic, so we got to kind of a gel with this kind of new environment. So doing it is a kind of a webinar approach. So I hope that you're able to have a good experience in my presentation. All right, so now let's get started over here. So let me, all right. So yes, so today's market outlook will be Q1. So what I'm sharing with you all is based on technical analysis, okay, rather than fundamental analysis. There will be lots of chart. So let's say towards the end, if you do not understand what this chart is telling you or us, or what I'm talking about, just feel free to actually uh, tap in at the Q&A session. All right, good. Yeah, great, great, great. So let's get started over here. Uh, okay, so before we start over here is that let's flash the disclaimer slides first. All right. Okay, good. Ready to go. Okay, so basically, a brief introduction about myself. I'm actually with in the markets for close to 14 years. So I actually specialize in the forex market first, FX. Then over the years, I start to branch into long short equity as well as the stock indices. So trading as well as analyzing the FX market and the stock market has been my forte. Using technical analysis as my primary tool, as well as combination with fundamental and sentiment analysis. All right. So for those who wants to actually follow me on Twitter, which I've been active on Twitter, you can actually follow me at Kelvin SC Wong. Just tap Kelvin SC Wong, just click follow. Then you're able to follow my market updates on a regular basis. All right. So now let's get started. So as a start, all right. So for me, as like I said earlier on, is that my primary tool to actually analyze the market will be using technical analysis. So what is technical analysis? So basically, technical analysis in a nutshell is studying market sentiment towards traded asset classes. That means the price action of traded asset classes. From there, we try to decipher whether the market is bullish, bearish, okay, over bullish or over bearish. Then we form a opinion on the market. So to me, everything is related, boils down to the price action of financial asset, prices of financial asset. I do not say that fundamental is not important. Yeah, fundamental analysis is still important because it do tell us that whether the economy is growing or is not growing. But the thing about fundamental is always lagging. There's always one or two steps behind ahead of before price actually took shape. Okay, one example I'd like to share with you all is, do you all know that recently there's this big hoo-ha about China clamping down on China big tech, all right? China big tech stocks like Alibaba, Tencent, Meituan, whatever, during the last 1 week of December 2020. So very strangely, yes, the price of this stocks actually plummeted. But very interestingly, do you realize that they actually starts to stabilize in the first week of January, which is around 2 weeks ago? And apparently today, Alibaba rallied, it actually create a kind of a positive feedback loop in the rest of the China big tech. Okay, so the key thing over here is that prior to this rally, there's a lot of negative sentiment inside the market on China big tech. But how come the share price of this China big tech did not actually collapse in the last 2 weeks? Ask yourself this question. And also, do you realize that just because today Jack Ma appeared in a kind of a digital platform, it actually managed to pull up Alibaba shares and as well as the rest of the China big tech, which is actually not related to Alibaba business model as well. So do you see that there's this kind of positive feedback loop that's being played into the market? All right. So this is the example of what I call technical analysis. Yes, for some it can be irrational. Okay. But the key thing is I'd like to stress over here is that market moves based on emotion, sentiment. So it's a mixture of rational and irrational behavior. So the key thing about technical analysis is that we don't care whether that behavior is rational or irrational. The key thing about technical analysis is to identify the trend bias, the key levels, and to gauge whether this ongoing trend bias, be it bullish or bearish, does it have enough room to run up or run down further? Okay, so that's the key aspect of technical analysis. All right. So I do want to jump more about technical. What is technical analysis and how does it apply in trading or analyze the market? So that I will cover in my next series of educational workshop. So do keep a lookout for it. So I will kickstart my education workshop again. For those who actually previous attended some of my education workout in the past for 6-7 years, I have this Trading Like a Pro series. So I do intend to kickstart this series of seminar over at CMC in the coming month of February. So do keep a lookout on that. So now back to our quarterly outlook. So the first chart I always like to analyze for a longer term perspective, we talk about 1 to 3 months, is to understand the liquidity in the system. All right. So what I'm showing you over here is actually a composite index being compiled by Bank of America Merrill Lynch, the investment bank, the quite global financial stress index. So basically, right, this stress index actually is a composite of central banks, I think we talk about the global central banks weighted according to their GDP, their money supply, their interest rate. You have VIX as well coming into the picture. You have some credit spread as well. So it's a composite of what I call indicator or an indication whether the global financial system is tight or loose. Okay, what I mean by tight? Yeah. So if you see this financial stress index that is spiking upwards, like you can see on mouse here, this is during the Lehman Brothers subprime crisis in 2008. There's a huge spike up. So it's the huge spike up actually telling us that, hey, the liquidity is too tight in the system. Once there's liquidity is too tight in the system, it's actually not good for risk assets like equity. So we tend to see a kind of a equities or other risk asset, we call like junk bond. There'll be for what I call pronounced downside pressure. So this what happened again in somewhere around February, March last year. The liquidity tightened, okay, reinforced by the pandemic crisis. All right. Then where we see a kind of we call negative feedback loop into risk asset. So where are we right now is you realize that right now over here, you actually start to dip down below the zero, which indicating to us that, hey, the liquidity in the system is still kind of loose, or there's abundant liquidity in the system that is supporting risk asset. So think about this way. Once there's abundance of liquidity in the system, this pool of money got to flow to somewhere to actually generate positive return, or a return that is higher than your risk-free rate. So what's risk-free rate? Think about risk-free rate as your fixed deposit interest rate if you place in a fixed D, be it 3 months, 6 months, or 1 year. So that particular interest rate is very, very low. So this pool of money got to search for higher potential interest rate, number one, to actually cover living expenses like inflation. So later I'll talk about inflation, which is a very important theme going forward in the next 3 months. So the key thing to ask ourselves is, yes, from this graph I see liquidity, but how low liquidity can it be where there might be a chance? If you look at it in the past, over here, there's a spike up. recently over here as well, there's a spike up. So how low this liquidity can go before there is what I call an opposite effect will actually cause the liquidity to tighten. And same thing, once liquidity tighten, it cannot tighten so much. Why? Because sooner or later the central bankers got to come in and repump in liquidity again. So how high can the liquidity go before we can say that, hey, that stock market or the stock market or equity has really do a kind of overreaction, sell off to the downside, where a potential major bottom can be formed. Okay, so to understand that, to study, to analyze that whether liquidity is at whether the tightness of the liquidity is at the extreme end or the abundant liquidity at the lower end, which is too much extreme liquidity, where central bank got to come in and tighten liquidity because the pool of liquidity in the system is too much, is I'll look at this one called Z score. Okay, so Z score, think about Z score is like a statistic formula where the dotted line is a mean. This plus 2 standard deviation, this minus 2 standard deviation. Anything that is going above the plus 2 standard deviation, meaning that the liquidity is tightened at the very far extreme, which is what we see over here in somewhere in March. All right. Anything that is at close to 2 standard deviation, minus 2, I would say, is that liquidity is too loose. There's a risk that the liquidity might be sucked out of the system by central bank tempering their current loose monetary policy. So what we are seeing over here is that the current loose liquidity in system or the abundance of liquidity system hasn't reached an extreme -2 level yet, which telling us that over here the liquidity in the system, the condition of abundantness hasn't overstretched and is still favorable for risk asset like equity in the next 1 to 3 months. All right. Now, the next chart that I will actually take a look is proxy of growth. Okay, so like I said over here is that I do not pay much close attention to economic fundamental indicator like GDP growth or money supply, because all these are kind of lagging. I want to see something that is leading. So what is leading is always demand and supply pressure for financial traded asset. That means that is what I call liquid asset that we can actually track on a very we call it frequently basis by opening up a chart on let's say CMC markets platform. So one of the proxy of growth is copper. Okay, why copper? So as you know that copper actually is an industrial metal. So what is industrial metal? So industrial metal requirement for industrial metal will be, I need to build infrastructure. I need copper for most of the machinery require copper. All right, this is the two easiest way to explain. If there is a demand for infrastructure, if there's a demand for machinery, it means that the economy is growing. That means corporations are actually starting to actually build up capital investment. So once this actually happen, the copper price will start to go up first. All right. So after all this scenario, prices, copper prices to go up, then you start to see your capital expenditure inside your economic fundamental metrics also start to go up. All right. So then you see fixed investment starts to actually increase, but all this will come at the later stage. So the first thing to actually analyze is it will be the price action of copper, which is a liquid traded asset classes. So technically, right, since January 2016 all the way to March 2020. So we have close to 4 years of sideways basing formation. Okay, we call it basing. In technical, we call it double bottom. At this double bottom, the duration is not short. Okay, RE, what's mean by short? Short, that means you're talking about a 1 minute chart or a 15-minute chart or 1 hour chart. Because all this short-term duration, i.e., financial markets can be manipulated. The shorter the time frame is easier for those guys who have bigger money to manipulate the market. But think about it, this is a long-term chart, it's a weekly chart. To manipulate a weekly chart is not so easy. It requires what I call it more of a combination of genuine demand that to drive up or drive down prices of weekly chart, which is copper. So we could see that over here is that this copper has really started to break out from a very long-term 4-year double bottom formation just recently, which is towards late last year at 32 this 327.40 neckline resistance. So the projected expected up move will be at this level at 452.50, 464.30. Lower boundary is a Fibonacci 1.618 extension for this 417.990, which is very close to the previous major swing high of 2011. All right. So all in all, what we could see that the potential movement towards this level here, we have still some more room to run. I.e., that means telling us that hey, demand for copper may still be going up further in the next 1 to 3 months, which is also indicating to us that global growth is solid on a strong footing at this moment in time, which is positive for risk assets as well. Now, the next proxy of global growth, I believe that you all heard of this semiconductor. Okay, semiconductor, why is it a global growth proxy? Because i.e. right now, we are talking about 5G. We're talking about technology, high technology equipment, high technology services, hardware, software. All this require semiconductor, the chip to actually run your I would say that run this kind of products. Okay, so if this semiconductor index, we call it the Philadelphia Semiconductor Index, the SOX, starts to move up higher, which means telling us that hey, there is ample demand for semiconductor chips, which translate to telling us that hey, global growth is still healthy. So by looking at the technical analysis chart of this is a monthly chart, it's a very long-term chart of this Philadelphia SOX index. So what we could see over here is that it actually start to have a very strong rally since March 2020. Yes, very strong rally over here. There's still no signs of what I call major bearish reversal exhaustion pattern or price configuration. Like we're talking about double top over here. Momentum wise is still pretty healthy. This is the RSI index. RSI index still pointing upwards, hasn't hit an extreme overbought level yet. All right, there's no kind of bearish divergence. So what is bearish divergence? Very briefly, is the price action of that particular instrument is going shaping higher high, but instead your RSI is not doing higher high. It start to shape what I call lower high. So that's why I call a first tell sign of momentum and starts to change on the downside. Over here, there's no change. Higher high on the RSI, higher high on the price action of this semiconductor sector index. So what we could see over here is that the next key resistance as driven, because now it's at the all-time high. So for all-time high over here is that the only way that we can actually pinpoint potentially where is the next level based on technical analysis will be using the Elliott wave and the fractal analysis approach. So unfortunately, I do not have time to share with you all what is Elliott wave and what is fractal analysis. Over here is actually based a kind of law of nature. So what we could see over here is that there is a combination of Fibonacci expansion level 0.618 and 0.382 at this 3927/4072. So that could be a potentially key resistance level that may pause this ongoing major up move that has started in March 2020. Okay, right now the key support for this index to hold this bullish bias will be at 1850 level for it to push up higher, potentially higher towards 3927/4072. Okay, this chart I actually did it in 2 weeks ago. So right now it already shape up higher already. So potentially you see about 25 to 38% movement more on the upside. This is the monthly chart, not a daily chart. So we have still some more room to move, which indicating to us that hey, another sign of what I call positive for risk asset in this coming 1 to 3 months. All right. Now the next chart. Okay, this is another chart which is actually linked to inflation that I share with you all. Why inflation important? Okay, you realize that okay, this inflation is actually represented by this Bloomberg Commodity Index. Okay, so as you know that if inflation starts to go up, pardon me, if this index, if commodity prices start to go up, so this is actually a basket of, think about it, is that it's a composite index that consists a basket of across the board commodities. Commodity, we have precious metal, gold, silver, we have oil. We have industrial metal like copper that I shared with you all. Then we have platinum, and you also have agriculture commodity like we're talking about corn, and we're talking about grain, all this. So it's a composite of this we call it various commodity. So I want to highlight to you is that the biggest weightage, close to about 30%, comes in energy, which is oil. All right. So so what happened now? So I pinpoint my mouse over here, so I hope that y'all could see my mouse. All right, so those who can't see, just give a shout out over here. So I believe that y'all can see my mouse. So this mouse is actually the bottom of this the bottom of S&P. Okay, the green line is S&P. So I use S&P as a global proxy of world stock indices. Okay, given that S&P is in terms of GDP wise, it's actually weighted the most in terms of global GDP. US, but US is still not the number one. We call it number one country weighted in terms of GDP. Yeah. All right. So now this particular mouse I'm pointing is the March 2009 low, which is the start of this current long-term circular bullish uptrend for global equities. All right, for S&P as well. So if you realize that this start of this ongoing what I call long-term circular uptrend for global equities comes at the expenses of low inflation. This low inflation can be reflected by this Bloomberg Commodity Index that is shaping lower high, lower low. All right, at the expense of this. Okay, so now go back to this portion here. Prior to this steep fall of 48% during October 2007 to February 2009, up to February 2009, which is over here, this period in time, there's this fall in 48% on the S&P 500 index. As you all know that, yeah, hey, there's this subprime crisis going on. But prior to this subprime crisis, I want you all to realize that what is the price action of financial asset classes is telling us. Is there any kind of pre-warning sign that we can take a look at it? So interestingly, yes. So if you look at it over here, is right, do you realize that at this point in time, the rally of this commodity price index, the Bloomberg Commodity Price Index, is much more pronounced, steeper than the rally of the S&P 500. So this can be actually seen on the ratio chart I plotted at the bottom, which is taking a kind of a division between the S&P 500 divided by the Bloomberg Commodity Price Index. So if this particular ratio is sloping downwards or flat downwards over here, it means that the rate of movement on the S&P is lesser than the rate of movement as seen on the commodity price index. So you call it a kind of divergence. You realize that over here, S&P price going up, but this ratio is not going up. It's kind of slope sideways. Okay, then prior to that, it give a warning sign that, hey, after that, the price of S&P collapsed. So over here as well, in August 2000, all the way down to September 2002, this is due to the dot-com bubble, there's a 44% decline in the S&P. Prior to this decline in the S&P, yes, S&P going higher, commodity prices also going higher, but the rate of commodity prices going higher is much more compared to the S&P. As you can see, there's this kind of divergence on the ratio chart. Okay, that means telling us that the magnitude of the pace of the up move of the S&P is lesser than the commodity price index. All right. So now, if you go back to this level over here, what is a very long-term chart? December 1972 to August 72, 43.5%. Okay, so in fact, right, what I actually did over here is I try to plot the significant down move, the down move of the S&P. Okay, so if you look at the S&P chart, right, since the early 1950s, there's only 3 times or 3 episodes that actually it falls, the S&P fall more than 40%, which is this period, and this period. Okay, so we could see over here is that this fall in S&P, what causes it? The prelude or the pre-warning sign is very similar as well. There's this divergence seen on the ratio chart, telling to us, indicating to us that the magnitude of the increase of the Bloomberg Commodity Index is much more than the S&P. So what causes it to actually fall? That means it actually tells us that, hey, inflation pressure has starts to kick up too fast and too much. So once that happens, right, central bank will kind of give a bit of guidance to tell us, hey, I could not allow inflation to go up much higher. So they will give a kind of more hawkish comment that actually could actually drive down equity prices. Okay, as seen in the last 3 episodes over here. So now we are now concerned about this situation over here. You see, so in this situation over here, yes, do you realize that commodity prices now has starts to go up already? Interestingly, in the last 1 to 2 months. So this push up in commodity prices over here is that the movement of the S&P 500 seems to be that it's almost the same. It's not, it's kind of flat. It haven't diverged yet. So what it indicate to us over there, hey, the risk of what I call higher inflationary coming into the market is not there yet until this index starts to shift, go up by a very steep pace, much steeper than the rate of increase on the S&P 500. This is where we got to get a bit of concern for risk asset like equity, which potentially it could run its course already over here. So what we are seeing right now is a kind of lagging indication. Okay, usually inflationary expectation will tend to lag behind, behind behind the economic cycle. So we may perhaps come to the kind of a tail end of this economic cycle, or tail end of this market cycle that started in March 2009, but it has still has some more room to run. Okay, more room to run. So we're talking about we're not seeing a kind of a potential imminent market crash at this juncture, as I highlighted the various chart that I shared with you. All right, good. So now let's move on pretty quickly over here. This is the Bloomberg Index. So the levels that I like to watch over here is this, the monthly chart will be at this level at 104.50. So if there's a break above this level at 104.50, potentially we could see a steeper increase on commodity prices going forward. But there is a kind of an indication from the indicator already, from the RSI indicator, lower low, higher low, bullish divergence, indicating to us that downside momentum has already decreased by a fair bit. Pre-signal on the RSI, you realize that the RSI lower high, lower high, this lower high actually coincide with the high of this on the index. And what you see on the RSI is there is a bullish breakout recently, just about a few weeks ago, about a month, about 3 or 4 weeks ago, on this former resistance that is capping previous lower high. So it gives us a kind of indication that in terms of probability, yeah, we may start to see a kind of a potential bullish breakout on the commodity prices. So that's why right now, if those who are very monitoring in the stock market, especially US stock market, we start to see previous laggards, which is energy related stock, now starts to actually outperform the market very significantly in the last, I would say 4 weeks or so, 4 or 6 weeks or so. Okay, so now this is the return on share view. Also, what thing I want to highlight over here is we all agree that over here is that in the last 8 to 7 years, we have been talking about US big tech. This is the sexy name, US big tech. Thanks, Facebook, Apple, Amazon, we're talking about Netflix, Google, Microsoft. All right. So yes, they're very sexy. Why? Because since the start of this long-term circular bullish market for global equities, 935% without any dividend, purely on the price action, 935. Okay. Asia actually not that much, not so fantastic. MSCI Japan, Asia ex Japan, 171. Europe, the worst, 87. Then you have emerging market about 108%. All right, so the one that is going up more than 8 times will be your Nasdaq 100. So you start to see there's a lot of crowding impact in the last 6 to 7 years. Fund flows has been flowing into the US big tech names. All right. So what's interesting over here is, okay, this is last year's year to date performance. You can actually take a look. So I want to highlight over here is, if you realize that as we reduce the time frame from June to December last year and to the last quarter of last year, Q4, you could realize that over here is that the return on the Nasdaq 100 is getting, in fact, lesser. All right, lesser. So what's interesting over here is that you realize that the one in terms of Asia ex Japan, even Japan itself, or then we're talking about emerging markets, even Europe, they actually starts to actually outperform the US market, the Nasdaq. So the US market, yes, definitely the stellar performance is the Russell 2000. This is due to the upcoming physical stimulus, and in fact, potentially it could be more implemented by Biden administration. All right, because they have this more politics. They do have this kind of socialist blend. Okay, I don't touch more about that. So you could see over here is very interesting that Asia and emerging market starts to outperform. Okay, now this is more obvious. This is the ratio chart again, and it very quickly. This ratio chart, what I plot is the S&P against the various region over here. So what we could see over here is that since May 2020 last year, this ratio chart has started to point down across S&P against the rest of the region, emerging markets, Asia and Japan, and even MSCI core Europe. All right. So we realize what it means that if this ratio is plotting downwards, that means S&P is actually underperforming the rest of the region. Very interestingly, from May last year. Previously, since 2009, it has been slowly going up. So the key thing over here is that if you realize that the outperformance of S&P is actually directly correlated with the strength of the US dollar, as seen on the US dollar index. So what we could see is that, do you realize that recently on May or early part of the year, somewhere around April, the US dollar index starts to decline. All right. So what we could see over here is that if there is this dollar weakness is actually showing outperformance or leading to underperformance of the US market against the rest of the world. That means this dollar weakness is actually benefiting Asia ex Japan, emerging market, and the rest of the world. Why? Because of dollar weakness. So this is the monthly chart of it's a monthly chart. So what we could see now, dollar index now is trying to actually test this 88.40 level. So if this level starts to actually break down, it could actually further amplify this S&P US market, stock market weakness against the rest of the world. So in fact, we could actually start to see it right now. If those who are actually monitoring the Asia major stock market, think about it, in the last 2 to 3 weeks, start of year, you realize that actually Hang Seng now actually outperform. Later I'll show you why Hang Seng outperform, because it break out a key level. Hang Seng Tech, a composite of China big tech, outperform the US big tech, despite China claiming that they want to clamp down on the big tech sector. It still goes up, making fresh all-time high. Whether it's rational or irrational, but for me, if I look at technical analysis over here, it seems to me that the momentum is still there at this point in time. All right, so now let's go on to the next chart. Will be this. As you could see that over here is that, okay, back to the chart, Asia ex Japan, which is consists of Hong Kong, China, South Korea, plus Singapore, Philippines, I think, excluding Japan. Emerging markets, these two, that has been outperforming the US. So if you realize that, what I did, I plot a correlationship between the performance of emerging markets, which is in red, and Asia ex Japan, overlay it with the dollar yuan, the renminbi, CNH, the offshore rate. So what I did over here is US dollar. I invert it, US dollar per CNH. That means it's 1 CNH is worth how much USD. So if this blue line, the US dollar per CNH is sloping upwards, it means that the Chinese yuan is strengthening against the USD. You realize that this China yen strengthening has a very strong positive correlation on the ongoing performance of the emerging market and Asia ex Japan. You go it across time, it's about the same. Renminbi weakening against the US, Asia ex Japan, emerging market stock price also go down. All right. Once it move up, it actually move up in line, causing the Asia ex Japan and emerging market to goes up. All right. So if you could see the correlation, right, since July last year has started to be very high, close to 0.9. Okay, this is the correlation coefficient, 0.9, 0.9. Okay, so what it means that over here is that if the CNH continue to strengthen against the USD, it will be one of the key drivers to actually maintain this ongoing major bullish uptrend seen in the emerging market and Asia ex Japan stock market in general. So later I'll show you the chart where I cover the FX space on the dollar CNH pair. Okay, hold on for a second. I know that some of you are eager to find out whether dollar CNH will actually continue to weaken. That means we're talking about US dollar weakening against the Chinese yuan going forward in the next 1 to 3 months. Okay, so now very quickly, I'll touch on the Asia X Japan index chart. So potentially over here, breakout. Next key resistance, we have 1060, 1060, 1420 level to go. Over here, you have the emerging markets index, EM. Very significant movement. Why? Because it just broke up close to around 12, 13 years. Okay, close to 13 years plus of symmetrical triangle consolidation. That means it has been going sideways for 13 years. It just broke out late last year. Potentially, it could go up to the top of the channel. Okay, this is in log since 1987. Resistance at 2974. All right, on the emerging market index. Now, so the first index I'll share with you is why Hong Kong actually rallied, or Hang Seng, Hong Kong 50 we call it in CMC platform, is called in the rest of the market we call it Hang Seng index. This is due to some copyright issue, so we call it Hang Seng index in our platform, so we call it Hong Kong 50. Why Hong Kong 50 actually outperform in these last 2 weeks? Because it actually technically it create a positive feedback loop by breaking above a significant resistance that has been capping previous recovery twice since its all-time high in January 2018. Okay, so this is the significant. Technically it kickstart a positive feedback loop pump. Okay, we don't talk about politics over here. We don't talk about politics. Purely, I look at sentiment. How does it drive it? And very interestingly, the previous move actually managed to being supported at a circular support at October 2018. Monthly RSI bullish, still has some more room to go before hitting the overbought level. Okay, so for now, for the next 1 to 3 months in this quarter, levels to watch out with this are as long as this key support holds 24,850, potentially Hong Kong 50 could actually move up towards 30,280. For this chart I plotted quite some time back, about 2 weeks plus ago. So right now it's already approaching 30,000. Yeah, this level, the first potential resistance. Next level 3280. Going forward higher will be the 32,300 level on Hong Kong 50. All right. So one more thing we can look at is Japan. Okay, why Japan? Because Japan is actually benefiting from this ongoing value play. Because Japan is considered as a value team play due to its relatively lower forward PE ratio. All right. So this monthly Japan, it actually has this bullish breakout earlier on in September 2014. Okay, over here. Then thereafter, it just goes sideways for close to about 2 years before breaking out in late last year, around November, December. All right. RSI hasn't hit the extreme overbought level yet on the monthly chart. So for this quarter, the key support level to maintain this potential bullish, ongoing bullish bias will be at 24,180/23,180. First major resistance 29,440, followed by the upper boundary of this channel that is in place since 16th of March 2020, coming in at resistance at 33,520/34,050. Also a confluence of a Fibo expansion level as well. All right. Now, definitely, when we talk about stock market, we cannot forget about US. Even though we do expect US tend to be a bit of underperformance going forward in the next quarter, but definitely all markets actually, in terms of directional, they got to go in line. That means we cannot see US market entering into a bear market or entering, we call it a kind of a pronounced corrective decline, where the rest of the world continue to make higher high and shape, a significant rally. So what's interesting about the US market is this monthly chart. Previously, everybody, in fact, those who actually go into the very active in Twitter or very active in Facebook, there's a lot of private we call it traders that actually share the technical outlook on the S&P 500. Okay, so over here in CCMC, we call it the SPX 500. You realize that in December, it actually shaped a bullish breakout above this, we call it this because that's an expanding wedge. So in technical terms, expanding wedge is actually telling us that yes, volatility is high, but it's unsustainable and it's actually one major bearish reversal configuration. Okay, so some of the traders that share in the social media space that they have a very bearish bias on the S&P. That means pinpoint to us that hey, this long-term circular uptrend is game over. We may start to see a very significant 30 to 40% decline that I shared with you earlier on by plotting the S&P 500 and the Bloomberg Commodity Index. That's not there yet based on that ratio. But this particular expanding wedge bearishness impact has already been negated by the monthly close, December monthly close above the upper boundary, the expanding wedge resistance. All right, so that's already no more. And what you could see the RSI as well. The RSI also shaped higher high, breaking from the previous corresponding resistance that is actually in line or confluence with the expanding wedge resistance on the price action of the SPX 500. It has still some more room to go to the extreme overbought level on the RSI. So long-term momentum is actually potentially supporting higher prices. All right. Okay, good. So before I start over here is that there's someone who said that they can't hear my voice. So can everybody give a shout out that everybody able to hear loud and clear? Yes, no? Good. So I'm not sure why someone can't hear. Perhaps you could actually it might be your one of the speaker, your computer speaker. You got to tune up a bit higher. Okay, good. So most of yours here is all good. Great. So let me continue. All right. Okay, now the strategy chart for this quarter. All right, this quarter on the SPX 500 is the resistance to watch will be 3200, 3200. So as long as this 3200 hold, potentially it could slowly churn up towards 4450, maximum 4630. Okay, but as long as this key support, 3200 key support hold for this quarter, potentially the trend bias is still heading upwards potentially towards this first resistance at 44,500, maximum 4630. All right, so from there we got to be a bit cautious. So in terms of the Elliott wave, the Elliott wave count is a long-term circular wave 5. It's a wave 5. So that actually boils down also with the potential rate of increase that is can be more in terms of magnitude on the Bloomberg Commodity Index. So that could actually slowly drive up inflationary pressure into the market, which actually will translate to more hawkish or less dovish guidance by central bank, where after that we may start to see a tightening of that liquidity in the system. So that particular scenario is not here yet at this juncture. In terms of probability is quite low. All right, so at the moment in terms of technical analysis, based on what I shared with you earlier on, the bias is still on the uptrend for the S&P and the earlier index that I shared with you. So definitely Nasdaq. Nasdaq is the one of the favorite in the last few years. It's still trading in this long-term ascending channel. These are put in lock, okay, holding above this moving average support that is supported on previous dip as well, very nicely. 1, 2, 3. The previous steep move about 20% drop. So what I could see over here is the next resistance is at 15,130/300. RSI, yes, overbought, but not as here as an extreme overbought level as seen in the past. This is the 2000.com bubble. It hasn't reached into that extreme overbought level yet. Okay, key support level to watch on the Nasdaq for this coming quarter will be 10,670. Looking for a further potential trend bias to the upside to actually test the resistance 15,130/300, followed by maximum at 16,630/830. All right, so now I already covered the one thing about the small cap, the last one. So what you see small cap over here is that this one of the, it actually went up quite a fair bit because these are actually plotted this chart in the towards end of December. So now it's about coming it's about 22,000 plus already. So the potential price bullish exit projection is at 23,000 2310 slash 2365, maximum 24,600 for the small cap. So still a bit of room more to push up. on the small cap index as long as 1560 holds for this quarter. Okay, now going on very quickly to the German index over here, DAX bullish breakout from close to 2 years plus of range configuration, range resistance at 13,600 recently. This the start of this late last year. All right, key support to watch for this quarter 11,330, 11,330, looking for a further potential push up as long as this level holds 15,020, followed by 16,685 on the German DAX. RSI still pretty positive. Okay, haven't actually hit the overbought zone yet. Okay. Okay, now going to some team play. So I'd like to share with you all now is I covered the broader base index over here. Is that right now is that we all know that certain shares in the market, why they do outperform the broader index, like you're talking about China big tech stocks, maybe US banks also. So one of the team that is actually developing right now that could actually last into this quarter is this rising US Treasury yield. So you realize that this rising US Treasury yield, as plotted by this red line, is actually break. So right now it's already broke out from this their former resistance, former resistance over here, which is at 2018 level. So it already broke out to levels not seen 2 years ago. So you realize that this steepness, this US Treasury yield that is moving upwards, we call it yield curve steepening. That means the 10-year yield is increasing at a faster rate than the 2-year yield. It actually lead to an increase in your bank stock. Okay, this is the SPDR S&P banks, a composite of banks, US banks. Okay, it's an ETF. Bank stocks is also increasing as well, followed by energy that is actually making higher low, about to break this previous high over here. So it actually has a kind of a positive feedback loop towards the energy stocks as well as the banking stocks. If you look at the MACD of the 210 or the treasury yield spread, the yield spread is actually on a very positive trend configuration as indicated by the MACD index over here, that is actually sloping upwards above the zero line. Okay, so now we talk about, since we have this kind of theme in mind, right? Over at CMC, right, we also offer this kind of, we call it share baskets. Okay, so you could actually drop us an email to find out what's to our customer service hotline to find out more what is about this CMC US bank share basket. So actually it's actually consists of various US banks that CMC specially selected for to create a share basket to actually allow traders to actually take on a particular team play, or a team play that one has a favorable view or bearish view. Okay, so if you look at the CMC bank share basket, is very positive, still positive. Yeah, it has really gone up by a fair bit over here. So RSI at that kind of an extreme overbought level. So potentially we could see a bit of consolidation right now below the first resistance at 4,036 towards this 3590. Key support to watch for this quarter will be at 3440. Then thereafter it should show slowly potentially move upwards again to actually test the next resistance at 4260, followed by 4540. So as long as this 3440 level holds to actually maintain this a major bullish biasness for the next quarter. Okay, now the next one I'll share with you is, this one has yet to move yet, is the potential double bottom that is forming in our CMC oil and gas share basket. So the trigger level to actually watch will be at 7480 level, a clear break above 7480. So you're talking about a daily close. Key support level will be at 5940 for this quarter. Potentially it could actually inch higher to actually retest the 2018 to 2019 range top 9887, maximum 10,550, which is the FIBO 1.618 FIBO expansion level, as well as the trajectory projection, the potential exit from this double bottom bullish breakout from here. All right, so the next theme that I want to share with you all will be cannabis. Okay, so cannabis is about this legalization of this US, because a drug company that to use for health benefits in US. So this is actually gaining much attraction for this incoming Biden administration. So price action has really started to turn very positive in the later part in Q3 last year. Okay, in Q3 last year, forming a potential double bottom. All right. So the trigger level to watch out for is 4,050. Daily close above it could take us up higher towards this level over here, as long as this key support holds for this quarter, which is 3047, if 3046, pardon me. Yeah. So one of the with China Tech, also China Tech has really run up by quite a fair bit for this today or 3 days itself. So in fact, the first level has already been met, 6,110, because this chart I prepared it in last week. So what we could see over here is the next potential resistance to watch out for this ongoing potential upward trajectory for this coming quarter will be at 6,450, 6,695, as long as this key support holds up, which is 5,510 on the CMC China Tech share basket. All right, so I've covered much ground on the equity space already. Share with you certain key charts to watch out for, and certain teams that we could actually keep a lookout by we call it looking into CMC share basket. So in fact, these are the various I will share with you about 4 share basket teams. So to find out more what other share basket that we have close to about 22 share baskets. So you could actually go into our platform or give us a call, a customer service hotline, a call to find out more about this share basket. All right. So now let's move on to the next asset class, will be FX. Okay, somebody asking chart for gold. Relax. Okay, so please be patient. I will share my chart for gold later after I cover the FX market space. All right, great. So FX market. So you could see over here is that this is the yearly 2020 yearly performance. So I actually plotted the major currency against the dollar. That means, i.e., 1 Aussie equals to how many USD. So what we could see over here is that ever since this huge plunge in the pandemic crisis last year, the rest of the major currencies, we talk about the Aussie, the Swiss, the Euro, the Kiwi, China Yuan, Japanese Yuan, Sterling Pound, Canada Dollar, all of that has really has appreciated against the dollar. The top performer will be the Aussie dollar. Okay, definitely. Why? Because Aussie dollar is a high beta currency that has a kind of a, what do you mean high beta? High beta, that means it moves much faster. It moves accordingly to risk on behavior. That means, i.e., if the environment as a whole is risk loving, that means investors or traders are not afraid to aggressively build up risk asset like equity, junk bond. So in this kind of scenario, we will tend to see an outperformance of high beta currency like Aussie. Okay, so now a lot of us are concerned over here. Yes, Aussie have moved a fair bit by 10% or so. We may start to see a bit of concern that has it been overstretched yet in this coming quarter. All right. So let me share the chart of the Aussie dollar. Okay, so bear in mind over here, this technical analysis on this various FX pair going to carry out is for the quarter, means long-term chart. I mean, I'm looking at a weekly chart. So definitely during the shorter term period, let's say when we are talking about now, we may start to see a bit of this kind of dollar rebound, corrective rebound over here, which I actually share with you all in some of the CMC alpha clients or my more shorter term technical outlook. All right. So now moving on to the longer technical outlook on the Aussie dollar. So what I see on the Aussie dollar over here is this: there's this long-term resistance level, this descending resistance level that is linking its all-time high at 110.81 on July 2011. Okay, over here, 8075/8295. So what's interesting over here is that the monthly, this is a monthly chart, the monthly RSI has started to show positive signal. Why? This is a downtrend. Okay, trend is still down because at the moment, because there's no breakout of this key resistance level, but your RSI is shaping bullish divergence. That means what we could see the last lower low, mind you, this is the monthly chart. It's not an hourly chart or a 15-minute chart or even a daily chart. It takes time to form. So when it takes time to form, that means the price action has really accumulated a, what I call it, accumulated potential initial to shape a significant movement, a very high significant movement, is similar like is storing of energy. So the storing of energy on this Aussie dollar is quite significant in the last 2 or 3 months by this momentum indicator shaping bullish divergence monthly, and it starts to break out its corresponding resistance that is in line with the resistance of the price action. So as you all know that momentum is always, rate of change is something as a leading indicator in terms of price action. So think of it as this: in order for a car to come to a stop, it got to slow down its speed first. So in order for a car to reach its destination faster, it got to increase its speed. So this, very simple, this RSI actually is like your speed. Measure the speed of a car. So the speed of the car right now is accelerating after been stalling for a very long period of time. So you realize that the potential initial or the potential feedback loop that it can have will be pretty tremendous, by as seen on the RSI over here. All right. So now the strategy chart for this particular quarter is, definitely this level got to break first, the significant resistance 8075/8295. A weekly close above this level, because a weekly chart, it could take us potentially higher towards 89 figure, maximum 93.50. Key support level to watch will be at the 70 figure level, 0.70 level on the Aussie dollar. Okay, moving on to the Kiwi dollar. So Kiwi has really shaped a much earlier bullish breakout on this head and shoulder, pardon me, inverse head and shoulder level, second half of last year, or third quarter of last year, pardon me. Key support will be at 67.90. Now looking for this. Okay, in fact, now it's somewhere around here. This region, just 73.80/75.60. The RSI should be at the overbought zone already, because this chart I plotted was 2 weeks ago. So we could see a bit of consolidation first before shaping another potential up leg to actually target, potentially test the next resistance at 80.80 over here. All right. On the euro dollar, all right, euro dollar over here. Okay, so for the euro dollar, what we could see is that potentially it's actually forming a double bottom, and it's a very long-term double bottom, close to 4 years plus. And what's interesting is in the month of November, it actually staged a bullish breakout from this long-term circular descending channel resistance that is in place since April 2008 high. All right, so right now it's actually right below the neckline resistance at 2340/2555. So where right now, potentially right now, we're just seeing a kind of corrective decline first, a kind of a consolidation before it can actually shape a potential higher move. So what we could see over here is that it could be still a consolidation, maximum 1850 level. Okay, so it got to break above this 2555 level, which is the neckline of the resistance, the double bottom resistance. A weekly close above it could actually reinforce a further up move to retest at least in the next this coming quarter at the May 2014 major high, okay, major swing high, 3840, 3950, maximum 4220/4410, which is the 1.618 Fibonacci expansion level. All right. On the sterling dollar, okay, sterling dollar. So on the sterling dollar over here, with Brexit totally out of the picture right now, in fact, prior to Brexit over here, it's actually shaping this kind of potential double bottom as well, with the neckline at 4380/5440. Earlier signs of a positive configuration is the bullish breakout of this descending, long-term descending trend line resistance that is from the high of November 2007. All right. So on the strategy chart for this quarter is 3270, 1.3270 will be the key support level to watch. Looking for this push up first to test the neckline resistance of that double bottom, which is 4380. Weekly close above it could take us higher towards 5140. So what's 5140, right? 5140 is actually this sharp push down previously in 2016. Okay, in July 2016 over here is during that Brexit drama period at the point in time. And also, if I go to the monthly chart, is actually this pullback resistance of this former range support that was taken down during this Brexit drama in that was actually linking previous lows since June 2001. So now in fact it's actually acting as a pullback resistance at this level, which is 51.5140. All right. So now going on to the next one will be definitely on the CNH, because everybody talking about CNH, because CNH strength has a positive, strong correlation on the ongoing positive movements seen on the MSCI Asia ex Japan stock market, as well as the emerging mar emerging markets index, which is actually outperforming the US market right now at this juncture. So what we could see over here is that now I plot the chart that we see commonly, which is dollar against CNH. That means $1 equals to how many CNH. So what I could see is we start to see a very, after hitting a high of 1719 in May 2020, it start to show a very kind of a very slow controlled decline in terms of the dollar CNH. That means CNH that's strengthening, that means dollar weakening. So right now what we could see over here is at the 640 level, which is a pretty important level in terms of FIBO, as well as this ascending channel, a circular ascending channel support that is in place since Jan 2014. All right, your RSI, there's no bullish divergence yet, but it's at a very extreme oversold level. So what we could see based on this extreme oversold condition, right now is actually trying to work out this extreme downside momentum. So what we could see now in the coming maybe 1 to 2 weeks, we could see a bit of consolidation on the upside, kind of consolidation below 6.5968. Maximum it could pierce up to 6.85, which is the 50% retracement of this current steep down move, okay, from May 2020 all the way down to the December low. We see over here 50% will be at 6.85. So as long as this 6.85 holds, we could see potentially breaking below 640 to actually target the next support level, which is 6.16/11. So all in all, right, yes, it's a kind of at an extreme oversold condition right now. Potentially no signs of a bullish divergence yet. That means from a technical analysis perspective, we don't the probability of doing a major reversal to actually reverse this uptrend to retest the channel is pretty low. Why? Because prior to that, we also start to see a bearish divergence, indicating to us that this circular up move, uptrend is losing steam. And right now, we are starting to see a corrective down move in terms of a longer term one. We're talking about monthly down move to actually retrace this close to about 6 years plus, 6 years of long-term circular uptrend that was in place in Jan 2014. So no signs of a bullish of a major reversal yet, which is i.e., which means that dollar can continue to weaken against the CNH potentially, which actually translate to further potential upside movement on Asia ex Japan stock market and emerging market stock market as well. Now moving on to the last major pair on the highlight will be the dollar yen. Okay, so this dollar is a very long-term chart. So since I think the high about November 1982. So what we could see over here is that it start to shape a kind of a downward trajectory. So since April 1990, right, it has been doing this kind of very sideways movement. Technically we call it a descending wedge formation. So what we could see now, right now over here is that there's this key major support is at 1030/99. So this support actually, number one, managed to help during the Brexit hoo-ha, the Brexit drama, as well as 2016 when President Trump won the election, and also recently during the pandemic, the pandemic issue over here. So right now, what we could see technically over here is that let me touch on the RSI first. The RSI, yes, it's going downwards, but it hasn't reached the kind of a extreme overbought level yet, or the overbought level that actually potentially could lead to a significant rebound in the price action, okay, which is at 21 level. So there's still some more room to maneuver before hitting this extreme overbought level that could potentially see a rebound in price action on the dollar yen as seen in the past prior movement. So then in terms of Elliott wave, those about Elliott wave is that it actually is now transpiring or evolving with a descending wedge with 5 wave movement, A, B, C, D. Then we have one more leg, the E wave, before this descending wedge end, where we could, as you all know, that technically descending wedge is actually a very, very long-term bullish bullish reversal pattern. So once the price starts to go down to the lower boundary of this wedge, which is 76.20, and if we start to see a bullish divergence on the monthly RSI, there's a high chance that this descending wedge has ended, and we maybe start to see a very strong bullish reversal thereafter. But that could take years to form. Not tomorrow, not the next 3 months or the next 6 months, all right, or even a year, because this is a very long-term monthly chart that take us back all the way back to 1990. So if we're talking about 38 years, all right. So now for the strategy for this quarter, so I'll plot on the weekly chart. So definitely the key resistance will be this descending resistance that is keeping previous rebound since 2015 at resistance now at 109.85. Definitely we need to see a break of this key support level that is supporting during the Brexit crisis over here, as well as during Donald Trump's shock presidency victory. 101.30/99, which is the shadow, the tail. So if we start to see a weekly close below this level, we could take dollar yen much lower towards 94.75/93.80 on the dollar yen. So overall, I covered the FX space. So it's still much of a what I call dollar weakness story going forward in this coming quarter, and this dollar weakness story could actually translate to potentially support the ongoing major uptrend for stocks and stock indices that has been taken shape since March 2020 last year. So before I touch on commodities, someone asking me about the chart for dollar sink. So unfortunately, because dollar sink is not a kind of a major traded currency, but being Singaporeans, uh, everybody is concerned about dollar sing as well. Okay, because definitely we go for holidays, potentially if you want to go for holidays, or we start to buy online shopping, okay, buying things in US or buying things in China. How does dollar sing look? So overall, right, actually dollar sing is actually tracking these two currency. From what I observe is the euro dollar and the dollar Chinese yuan. So especially on the Chinese yuan in the last few 2 or 3 years, due to our trade ties with China in terms of goods and services, as well as money flow between our two countries. So definitely dollar sing will start to see further potential downside as well. But unfortunately, I do not have the key levels to share with you all right now. But nevertheless, I will actually post a weekly dollar sing chart on my Twitter with the key levels to watch tomorrow. So you can actually follow me on my Twitter, and I will actually post this dollar sing chart up tomorrow for you all as a reference. All right, good. Now, going to the commodity price. Okay, so what's interesting about the commodity over here is, let me touch on gold, the weekly chart. So for gold over here, right, you know that since this August push up, August we quite the all-time high at 20,075, it start to do a consolidation or a pullback. Okay, a pullback. So where this particular pullback actually stopped, very interestingly, it actually stopped or still stalled at the former range resistance of 2013 level, 2013, this 20 level over here, and also this this moving average, which is a 20, okay, it's a 20-week moving average over here that is supporting previous dip in March 2020, previous 2020, and as well a dip over here in 2019 as well. One time, two times supporting it. And right now, if I were to draw a channel for March to 2020, is actually the channel support as well. So the key support for this quarter will be at 1765/25, which is the 38% retracement as well from this ongoing major rally that is in place since August 2018. All right, 2 years plus. So what we could see now is a bit of consolidation below the 965. So if you look at the last rally 2 weeks ago, it actually stopped about close to 1900 level. So I have 965 over here, which is this high. So it got to have a kind of a weekly close above 965, which is a key resistance. So for those who knows a bit of chart pattern, right, potentially if we go down to the daily chart, we could see as a inverse head and shoulder, head, shoulder. It's forming a shoulder here. So it takes a bit of time to consolidate. Weekly close above 965 should take us up to test the all-time high at 2075. Above it should goes up towards the top of the channel over here at 2350/410, which confluence with a Fibonacci expansion cluster level as well. RSI bouncing off from the support level. All right, in the last I would say the last two months plus, it's still holding above this support level. So overall, gold is still being supported, but however, it's more of a consolidation pattern. It's a longer term play. It got to break above 965 to potentially take us much higher in the months ahead on gold. Okay, so the last commodity I would like to cover will be this light crude oil futures, okay, LCO futures. So as you all know that LCO futures, it did historically negative 40.32. I think so far, yeah, it's in history in mankind, there's no negative 40.32 in the history of oil, or even we call it the normal financial asset classes, except for interest rate, which is negative. So what we could see now is yes, it slowly starts to push up in line with so-called the risk on behavior that we see that has already taken shape since the start of March 2020, during March 2020 until now. Pardon me. Then what you're seeing now is coming now. It's about trading close about 55-60 level. All right. So there is a major resistance which is at 75.70. So what is 75.70 is graphically is this swing high, this former swing low, and as well as the descending resistance that is capping previous rebound since July 2018. All right, July 2018. So what we could see now is more of a sideways movement, top side, potentially cut at 75.70. Unless we have a weekly close above this level, then you could see oil prices going higher to 110. All right. So fundamentally now it's a bit tough. Why? Because if you look at currently the ongoing global government, or even right now US right now, the incoming Biden administration, they are kind of more of going into ESG, clean energy. So yes, clean energy still require oil to run certain parts of the ecosystem, but less reliant on oil. Okay, so fundamentally speaking, in terms of this going forward with this more reinforced or more pronounced clean energy projects driven by US and the rest of the world, and even China right now, encouraging electronic vehicle in terms of production or in terms of demand. For oil prices going above 75.70 is a bit challenging at this moment in time. So I will actually have a neutral stance for oil, 75.70 on the top side. And on the bottom right will be at this support, okay, the former lows from here that has been sharply recovered after this negative move, came down a bit, tested, and shaped a kind of very sharp rebound in the last 3 months. So this support level is at 33.55. So more of a neutral stance between 33.50 and 75.70. Okay, so I've covered almost all the major asset classes, giving a kind of a global macro outlook from a technical analysis perspective. So do let me sum up a bit. Okay, so what we see over here is on the equity space, we are still pretty positive over here. Number one, driven by abundant liquidity. Liquidity is still abundant, but not at an extreme low level where we may start to see a bit of central bank tempering or we call it a hawkish intervention to actually try to reduce the liquidity system. Is not there yet. Commodity prices, yes, it's going up sharply, but the rate of increase hasn't outpaced the rate of the global equities as represented by S&P 500. So overall, we may not start to see a high inflationary environment that may kicks in the next in the next 1 to 3 months. Now I'm talking about 1 to 3 months perspective, that could actually lead central bank to become more tilted towards the hawkish stance. All right, and dollar still remains weak at this point in time, which yes, we may see a bit of corrective pullback, corrective dollar rebound in the maybe 1 to 2 weeks or so, but the overall major trend seems to be down from a technical analysis perspective that is in place since March 2020. With dollar getting weaker in this coming quarter, potentially, it could actually support global equities, and we start to see continued outperformance in Asia ex Japan and emerging stock markets. Okay, no big crash in US big tech because we cannot afford, yes, even though the performance is much lesser compared to the rest of the world, but technically the trend is still up. All right, copper, semicon, sectors still doing fine in terms of technical configuration, still positive, supporting this ongoing risk on perspective. Commodity prices, gold is still kind of a sideways, got a break 1965, but is trading more of a kind of a bullish configuration. Lastly, for oil, more sideways between 75.70 slash key support, the lower boundary of the neutrality range will be at 33.55. All right. So with that, I kind of sum up everything. So what could actually derail this ongoing risk on behavior? Number one is what we could see: vaccination. The ongoing vaccination has proven to be ineffective. That means suddenly we start to see a lot of signs that telling us that, hey, people suffering from side effects. This vaccine is kind of ineffective, so everything will be thrown down to the drawing board, back to square one on vaccination. So that could derail this risk uh, risk risk on behavior. Our base case scenario for now, risk on, not risk off, risk on behavior. The base case scenario for now for this quarter, and also suddenly Biden administration comes in, and one start to be more hawkish towards China trade. That means they start to reimpose more tariffs on China, kickstart what I call tit for tat, war of words, Cold War, all this hawkish administrative system. Once this kickstart over here, it could actually derail this risk on behavior as well. And also another potential one will be suddenly uh, the next 3 months, the Congress starts to kickstart this antitrust measure, a very, very more stringent one, to break up Facebook, break up Google, and potentially break up Amazon. So that could actually see a kind of a major negative feedback loop in terms of portfolio adjustment. Why? Because if you look at the last 8 to 9 years, a lot of major portfolio, because hard money for the long term, it tend to skew towards the US stock, because these guys are, the market cap has started to increase significantly. So for those funds who are actually benchmarking the US stock market, they tend to have significant we call it a portion in this big tech stock. So what if suddenly Congress starts to break them up very fast? I just break them up immediately without any consideration. It could actually lead to a kind of a trigger, a kind of sell off, a potential adjustment on the downside that could trigger this negative feedback loop across the board. So that's how sentiment work. So unless these three scenarios take shape, all in all, the trend biasness in terms of technical analysis still support this base scenario, which is the risk on scenario that I explained to you earlier, and the charts that I shared with you for this coming quarter. All right, so I ended my presentation. I hope that you all enjoy it over here. So we do have a bit of Q&A session. So I could actually answer a few questions for the next 5 minutes or so. Yeah, please feel free to actually tap on the chat box over here. So I try my best to answer. Okay, someone asked me what's the outlook on silver. So unfortunately, I do not track silver very closely. So yes, I can do a chart on silver. I can post it on my Twitter handle tomorrow. So keep a lookout. So I just take a note down, dollar, zinc, as well as silver. Yeah. Okay, so someone is asking about the Dow Jones. Okay, the Dow Jones US 30. Okay, so so I understand most people trade US 30, the Dow Jones as well. So Dow Jones, yes, is bullish, but to get the concrete level, I will post this chart on my Twitter, because to me, right, the US market, my key US market, the consideration that I look at right now is the Russell 2000, the S&P, the Nasdaq 100. Yeah, sure. Dow Jones, I could actually take a look at it. Okay, what's my comment on Bitcoin? Okay, very interesting about Bitcoin. Okay, so before I touch about Bitcoin, I want to share a bit about the current sentiment of Bitcoin first. All right. So as you all know that Bitcoin itself, it's been a very sharp rally, going all-time high. In fact, all-time high already after breaking about a base from a 2 years plus base. All right. So I want to take a look back in terms of sentiment. Okay, how the market actually behave. So do you realize that prior to this bullish breakout? So let's take a look back in history between 2015 to 2017. That was that previous peak, or late 2016. After that, the Bitcoin collapsed very sharply, did a sideways movement for 2.5 years plus. So during the last sharp rally, the last sharp rally in Bitcoin, it has been driven by a lot of speculative behavior in the market space. Okay, so what do we mean by speculative behavior? Okay, so speculative behavior, it means that you start to see a lot of companies that are not in the business of blockchain start doing blockchain and start to use blockchain technology as part of their business. All right. And even I think Kodak is one of them. Naming some blockchain thing and causes Kodak stocks to go up. Kodak. All right. So I think there's also one beverage company naming itself as some cryptocurrency or something that caused that beverage company to go up. And after that, you start to see people encouraging others or giving courses on how to mine Bitcoin and how to create your own mining station. And also we start to see celebrity endorsing ICO, initial coin offering, okay, during that point in time. The last short rally in 2016, 2017, or 2016, yeah, pardon me. But this current rally that takes shape in the later part of last year has not been accompanied by such speculative behavior, all right? So what it means that this push up in Bitcoin is being broken up from a 2 years plus base. So in terms of the longer term perspective, if you look at, there's this lack of excessive speculation that what we see in the previous rally. And right now it seems to me that there's more institutional money that is gaining acceptance in Bitcoin. Corporate starts to actually do a bit of what I call embrace Bitcoin as a payment, which PayPal did over here. So in terms of this kind of technical analysis and behavioral finance approach, potentially I could see Bitcoin going higher from here in a longer term perspective. But nevertheless, in the medium term, we're talking about 1 to 3 weeks or 3 to 4 weeks, we now start to see a bit of consolidation below that key resistance at the 42K level. So I do expect a bit of consolidation in this moment in time, potentially, to actually remove a bit of short-term excesses in the price movement of Bitcoin. All right. So now next question is recently Yellen said dollar cannot be weak, but wants more stimulus. How to read this statement? Okay, very simple. Politicians are politicians. To my experience, right, do take their words with a pinch of salt. All right. So now let's look at certain facts right now. We know that Biden has got to come in, incoming administration. What Biden's priority right now is, hey, I want to remove some of Trump's policy. Okay, while removing some of Trump policy, and I also want to emphasize, because Democrats being both houses, because don't forget, in order for Biden to go up at this moment in time, this is based on my own approach, some of your my own analysis on the political situation in US, he needs the support of the leftists, which is the socialist camp, which is getting very stronger, very pronounced in US, the Democrats. So this more left-wing Democrats over here, they want policies that could actually bring up the middle class to a higher level. That means they dislike corporate tax. They dislike how come the 1% is getting more and more richer due to stock market. So this incoming Biden administration they need to solve this problem, this scenario of bringing the so-called the middle class or the lower income to a higher level to close the income gap between the very rich and the middle class, as well as the bottom of the this social ladder, to bring them up. So in order to bring them up, right, there must be more policies on the fiscal side, more fiscal stimulus, perhaps wages got to increase per hour. All this is actually does not benefit corporates, US corporate. So in order to implement this policy, yet I cannot drive economic growth via the corporates. In order to sustain US GDP growth at this level, I need to make dollar weaker potentially. Why? Because to have a weaker dollar, this is where the rest of the world could actually buy US services in terms of whether physical services or computer services like for Microsoft or Apple product, to actually maintain profitability. So Yellen also know that, hey, the stock market is so an important driver of US growth. But I cannot be so obvious, Biden administration can be so obvious that, hey, I'm supporting the US corporate to drive corporate growth or to drive economic growth. So I need to be more on the socialist side to actually boost up income on the middle class and as well as the bottom class, which are going to be balanced. So it definitely will not it will not be more corporate oriented where we start to see massive tax cut like what the Trump administration did in the last 3 to 4 years. So all in all, right, to actually engage in this kind of more left-wing policy, fiscal policy, I need to have a softer dollar to maintain US growth at this level. So all in all, right, from what I see over here is that US potentially needs to have a soft dollar given the kind of stimulus that they want, fiscal stimulus that they need to engage in the next 1 year or so. All right. So I hope that could answer that kind of political question. That's based on my own opinion. From what I see right now in the U.S. political climate. All right. So can you pick up some stock next time? Well, hopefully, yeah. So hopefully in my next monthly webinar, hopefully it will be a seminar, because I love to see some of y'all again, because I do see some shout out from some of you guys over here is that you are pleased to actually hear me and see me in my just now. It's a very short screenshot of myself. So thank you very much for your support in the last few years over at my previous firm. So definitely I will try to do more stock team focus in my next webinar if the chance arises. So hopefully it can be a seminar, hopefully, yeah. If not, we got to do it, we got to embrace the new norm over here. All right. So yeah, so I really come to 8:30, just nice. So thank you for your time over here. So this recording, I will send this recording, then I will post it on the CMC YouTube channel, so all of you all could actually take a look at it from there. All right. So with that, thank you very much for your time. All right. So have a great evening and a great week ahead. Do stay safe and stay healthy, and I hope to see some of you all pretty soon. In fact, all you all soon. Thank you. Okay, thank you very much.